Hi, this is Impact Tuition. We begin discussions on the International Financial Reporting Standards. Today, we will start off with the less easier standards and work our way up into more complex ones. Our discussion today will focus on IAS 16 PPE. The discussion will follow this format. We'll first look at the objective of the standard, recognition, the measurement, which will be split into initial measurement and measurement subsequent to initial recognition, derecognition, and we'll end the discussion with disclosure requirements. Let's start. Objective of the standard. The objective of IAS 16 is simple: to prescribe the accounting treatment for property, plant, and equipment. In meeting this objective, the principal issues that the standard deals with are the recognition of assets, determination of their carrying amount, and the depreciation charges and impairment losses to be recognized. Good. So that is the objective of the standard: prescribing the accounting treatment for property, plant, and equipment. In doing this, the standard deals with the recognition of assets, determination of their carrying amounts, depreciation charges, and impairment losses to be recognized in relation to the assets. Recognition. What is the recognition criteria for IAS 16? The standard talks about two conditions that must be met in order to recognize an item as PPE. Two conditions. One is that it is probable that future economic benefit associated with the asset will flow to the entity. And then the second is that the cost can be measured reliably. These are the two conditions These conditions are set out in the conceptual framework for the recognition of assets. An item of PPE is an asset, so it must be recognized in the books using this recognition criteria. And the first is that it is probable that future economic benefits will flow to the entity, and the cost can be measured reliably. This recognition principle is applied to all PPE at the time they are incurred. This cost includes costs incurred initially to acquire or construct an item of PPE, and costs incurred subsequently to add to, replace part of, or service it. This is what this means. This recognition criteria is applied to all items of PPE at the time the cost is incurred. So we apply the recognition criteria at the time the cost is incurred. Now the cost includes those costs incurred to initially acquire, construct, and then the cost incurred subsequently to add to, replace part of, or service the item of PPE. This is the recognition criteria. The standard also recognizes that some parts of some items of PPE may require regular replacement at regular intervals. Now, when this is the case, the carrying amount of the item of PPE will include the cost of replacing the parts of such an item when that cost is incurred in the recognition criteria, if the recognition criteria are met. Now, the carrying amount of those parts that are replaced is derecognized in accordance with the derecognition provisions of the standard. Let's pick, for example, an airplane, which is usually sent for regular replacement of certain parts. At the time of the replacement of, let's say, a major component or a major part of the airplane, the carrying amount of the component which was replaced is derecognized, and then the new asset which was, or the new component which was added, is recognized, taking into consideration the recognition criteria. How do we initially measure an item of PPE? So measurement, but we are first looking at the initial measurement. Initially, The standard says that an item of PPE is initially recognized or measured at the cost. So initially, we recorded at the cost plus any other cost incurred to bring the asset to a working condition. For the intended purpose. Let's look at an example of those other costs. Now, this cost here represents the purchasing cost. Now, examples of the other costs includes delivery cost, handling cost, related professional fees paid to lawyers, engineers, taking into consideration the type of asset, installation cost, cost of site preparation, etc. This isn't exhaustive. There are a lot of other costs that will form part of the initial measurement of an item of PPE. Now let's use this as a quick example to determine the cost of an item of PPE. We bought the item for 80,000. Let's assume delivery cost is 2,000. Handling cost 800. Delivery cost, related professional fees 1,200. Installation cost 1,000. Cost of site preparation 500. In getting the cost to initially recognize the asset in our books, we will add these amounts: 80,000 plus 2,000 plus 800, 1,000, 2,500. And this is giving us 85,500. This is the cost of the asset at initial measurement. Having determined this amount, we debit the asset account with 85,500 and then we credit bank if we paid all these amounts to the bank, 85,500, and we are done with determining the cost of an item at initial measurement. What happens at subsequent measurement? The standard says that subsequently let's go back here and talk about something. Now, at initial measurement, we may test the asset in order to bring the item of PPE to a working condition, and then in order to bring it to a level for it to operate in a manner intended by management. Now, during such testing, we may sell some of the test products. The proceeds we make from selling these test products are not deducted from the cost of the item of PPE, but are recognized in profit or loss. Fine. With that said, let's continue and look at subsequent measurement of an item of PPE. The standard prescribes two models. The cost model and then the revaluation model. The cost model is straightforward. Using the cost model, the item of PPE is measured subsequently in this manner. The cost of the asset which was initially recognized minus accumulated depreciation and then impairment losses. Impairment is the subject of IAS 36. We will look at that later. This will bring us to the net book value or the carrying amount of the item of PPE in the statement of financial position at each year end. So that is all for the cost model. Let's continue with the revaluation model. Using the revaluation model, revaluations should be carried out regularly so that the carrying amount of an asset does not differ materially from its fair value at the balance sheet date. The revaluation model uses the fair value of the asset. Now, the fair value of the asset must be determined with reference to an active market. This fair value is the amount that knowledgeable and willing parties will agree to exchange the asset. When this fair value is determined, the entire class of assets to which that asset belongs should be revalued. What this means is that we can't decide to revalue one item from the class and then adopt the cost model for the others. If we have 5 vehicles and we are deciding to use the revaluation model for subsequent measurement, we have to apply the revaluation model to all our vehicles. We can't elect to adopt revaluation model for one or 2 vehicles, and then the rest we use the cost model. It doesn't work like that. Revaluations will bring about two things: a revaluation increase or a decrease. Or a revaluation decrease. How do we treat revaluation increase and revaluation decrease? The standard says that if the revaluation results in an increase in value, it should be credited to other comprehensive income and accumulated in equity under the heading revaluation surplus. So you have a revaluation increase. First, the revaluation increase is recognized in other comprehensive income, and then it is accumulated in equity under revaluation surplus. That is the standard. If there is a revaluation decrease, it is recognized as an expense in profit or loss, and then it is used to reduce amounts recognized in the revaluation surplus. In relation to the asset. This is the standard. Now, it is quite straightforward. Whenever you revalue and you have a revaluation increase, let's pick a very quick example. We have an item of PPE here. The carrying amount from the previous year is 2,000. Ghana cedis. At the end of the current year, the fair value is 2,500. It is obvious that our revaluation increase is 500 Ghana cedis. What happens to this? The standard says that if there's a revaluation increase, it is recognized in other comprehensive income. So we have a profit or loss extract under OCI. We have revaluation increase. 500. And we also have our statement of financial position extract. Under equity, we expect to see the capital, maybe retained earnings, yes, and then our revaluation surplus. Because the standard said that it is accumulated in equity under revaluation surplus. So the extra to look like this, we have the capital, the retained earnings, and then the revaluation surplus of 500 will show up here. This is how we treat revaluation increases. What if it is the other way around and we have a revaluation gain? A revaluation decrease. Carrying amount is still 2,000 from the previous year end, and then the new fair value was determined to be 1,800. This is still 2,000. Our revaluation decrease is now 200. So revaluation decrease is now 200. Our profit or loss extract will look like this. In the profit or loss, under expenses, we will have revaluation decrease. $200. Then in our statement of financial position, under equity, capital will be the same, retained earnings will be the same. If there is any year profit, it will be added. The focus is on the revaluation surplus. This expense here, the revaluation decrease, will be used to reduce this 500 in the statement of changes in equity. So our revaluation surplus will now be 300. So this is how an increase or a decrease resulting from revaluation is accounted for. There is another thing we should take note from here. The standard says that when a revalued asset is disposed of, any revaluation surplus may be transferred directly to retained earnings, or it may be left in equity under the heading revaluation surplus. The transfer to retained earnings should not be made through profit or loss. Whenever we have revalued assets in our books and we dispose of that asset, if the asset has an amount credited to the revaluation surplus account, that amount can be transferred to retained earnings or left to sit in the revaluation surplus. When we decide to do the transfer, we shouldn't do it through profit or loss. Instead, the transfer should be made directly in the statement of changes in equity. This is what we are talking about. Let's look at an extract of statement of changes in equity. We have at start capital, retained earnings, and then revaluation surplus, and then the total. So at the start of the year, for example, our capital was 2,000 Ghana cedis, retained earnings 600, revaluation surplus from our previous example was 500. The total is giving us 3,001. Now during the year, we had a profit of 800 cedis, which is transferred to retained earnings. So the total is 800. Now we have decided to dispose of the asset which brought about this revaluation surplus of 500. And we are deciding to reclassify the revaluation surplus and make a transfer to retained earnings. In doing this, we can call this the transfer or reclassification. We would recognize 500 here and then less 500 from here, and this is 0. Now let's assume these are all the transactions taking place in the statement of changes in equity. At the year end, so at close, we have 2,000 here. This is 1,900. This is 0. And this is 3,900. We should sum it this way to still give us the same 3,900. So this is how the transfer or reclassification is done. The standard noted that it shouldn't be made through profit or loss. It should be done here, and that is how it is done. Now let's look at a summary of the revaluation model. Summary of subsequent measurement. If the entity adopts the cost model, it is simply the cost minus accumulated depreciation and impairment losses. And this will give us the carrying amount to be recognized in the statement of financial position at the year end. The entity adopts the revaluation model it will either bring about a revaluation increase or a revaluation decrease. If it is a revaluation increase, it should be recognized in other comprehensive income and accumulated in equity under revaluation surplus. If it is a revaluation decrease, it is first recognized as an expense in the profit or loss, and then it is used to reduce or decrease an already recorded credit in the revaluation surplus. So this is the summary of the subsequent measurement. The next thing we will look at is the recognition. What does the standard say? Before this, let's look at some things to note. The standard says that for all depreciable assets, the depreciable amount should be allocated on a systematic basis. Over the asset's useful life. The depreciation method should reflect the pattern in which the asset's economic benefits are consumed. Depreciation method should be reviewed at least annually. And if the pattern of consumption has changed, the method should also be changed. Depreciation should be charged to profit or loss. And then finally, depreciation begins when the asset is available for use and continues until the asset is derecognized. Right. Now let's look at the derecognition of an asset. Derecognition. Oops. This is basically removing the asset from the statement of financial position. The standard prescribes that an asset should be removed from the statement of financial position on disposal when we sell the asset, or when it is withdrawn from use. Right. It is withdrawn from use when no future economic benefits are expected from its disposal. Now, whenever we dispose an asset, we either make a gain or a loss on the disposal. This gain or loss, according to the standard, should be recognized in the profit or loss. And we are done. You dispose of an asset, you can have a very simple disposal account. The cost of the assets here, say 2,000. Then your proceeds, 2,500, for example, and our gain on disposal is 500. This gain is then recognized in the profit or loss account. That is what this whole thing is trying to put across. With that said, let's look at some disclosure requirements and then we close our discussion on IAS 16. Disclosure. We have to disclose These are just some things. It is not exhaustive. There are a lot listed in the standard. You can just visit the standard to look at all the disclosure requirements. You must disclose the depreciation method, the cost or revaluation model if we adopted for subsequent measurements, the useful life of the asset, any revaluation increase or decrease, disposals during the year, additions during the year, and the carrying amounts. These are some of the things we disclose. Let's look at a summary of all we have done. We started with the recognition criteria. If economic benefits flows to the entity and then the cost can be measured reliably. And we went ahead and talked about the measurement, initial measurement, where we talked about the cost plus other costs incurred to bring the asset to a working condition. For the intended purpose. Right. Then subsequent measurement, we had two, the cost model and then revaluation model. Now we noted that using the cost model, subsequently the asset is carried at the cost minus the accumulated depreciation plus impairment losses. And this will give us the net book value or the carrying amount. And the revaluation model will lead to a revaluation increase or a revaluation decrease. If it is an increase, recognize in OCI, accumulate in the revaluation surplus. If it is a decrease, recognize as an expense in profit or loss and then reduce the amount in the revaluation surplus. And then we ended by looking at some disclosure requirements. So this is everything on IAS 16. Yeah, we are done. So kindly drop your comments and your questions in the comment section. See you in our next video. Thanks for watching.